Hello friends, this is my 31st presentation for the team of finance and accounts function, and the topic is 66 causes that can adversely impact the financial reporting of 6 types of non-current liabilities in the balance sheet. Part 1. Overall, this is my 62nd presentation considering all the YouTube presentations that I have made so far. What I plan to include in this presentation are following. Number 1, an overview of the 6 non-current liabilities, part 1. Uh, Number 2 is inaccuracies and ethics related 66 causes that can adversely impact financial reporting in the balance sheet. Uh, then there are actually six types of uh, non-current liabilities that I have covered. Type 1 is long-term borrowing, which can be secured, unsecured, bonds, debentures. Type 2 is long-term borrowings, which can be secured, unsecured, term loans. Third is type 3 is loans and advances, which can be secured, unsecured from related parties. Number 4 is type 4 is long-term maturities of lease obligations. Number 5 is type 5 is long-term deposits taken. Type 6 is the deferred tax liabilities. In part 2, 6 more types of non-current liabilities will be included in my next 30-second presentation for the finance account team, where an additional 55 related causes will be shared. Number 1 is overview of the types of non-current liabilities. Part 1. Causes that can adversely impact the financial reporting. Here you can see that in the column 2, the description of the non-current liabilities is given, and the this non-conformances are prescribed in under two heads. One is inaccuracies related, and number 2 ethics related causes. For example, in the long term, row number 1, long term borrowing, secured or unsecured bonds and debentures, 5 causes have been identified under the inaccuracies and 6 identified under the ethics related. Number 2 is long term borrowings, secured or unsecured term loans, 5 causes inaccuracy related, 6 causes ethics related. Loans and advances, secured and unsecured from related parties, 5 inaccuracy related, 6 ethics related. Long-term maturities for lease obligations, 5 inaccuracy related, 6 ethics related, and so on and so forth. So overall, 30 inaccuracy related causes have been identified and 36 ethics related causes have been identified. Now, as mentioned, 55 more causes will be shared in my next presentation, which will include 25 inaccuracy related and 30 ethics related causes in part 2. Now, type 1, long-term borrowings, secured and unsecured bonds. What are the important aspects for the finance and accounts team? These are 7. Number 1, principal amount, face value of the outstanding bonds. Number 2 is the issue at premium or discount. The premium and discount is amortized over the bond's life to be reported as a separate component of non-current liabilities. Number 3 is the interest accrued. Number 4 is the maturity date. Number 5 is security details if it is secured. Number 6 is restriction, if any, imposed by the bond covenants. And number 7 is statutory reporting requirements. And this will be based on the para number 8.3.1 in the guidance note on the revised schedule 6 to the Companies Act 1956, issued by the institutions of Chartered Accountants of India. So these are the broadly 7 aspects which are important vis-a-vis long-term borrowings for bonds. Now, similarly for the debentures, the important aspects are similarly principal amount, interest rate, repayment terms, security deposits, call or put options if any, conversion options if any, and statutory reporting requirements as mentioned in para 8.3.1. Now, inaccuracy related causes, bonds and debentures. Now, let me go back to the earlier slide. Here I have indicated for the bonds and debentures there are 5 inaccuracy related and 6 ethics related. So, let me go one by one. Now, first is inaccuracy related 5 causes. One is the incorrect principal amount. Number 2, improper amortization of premium and discounts. This can make profitability appear higher or lower than it actually is. Number 3 is omission of accrued interest, not reporting the accrued but unpaid interest as a current liability understates current liabilities and overstates equity, presenting a misleading picture of the company's financial health. Fourth is incomplete disclosure of the terms. Omitting the details like maturity dates, security provisions, or call put options can make it difficult for the investor to assess the true risk associated with the debts. Classification errors. Classifying short term debts as long term debts to manipulate the financial ratios that can mislead the investors about the company's liquidity and ability to meet its obligation. Ethics related causes related to the bonds and debentures, which can cause inappropriate reporting, incorrect reporting in the balance sheet. Number one is intentional misrepresentation. This could be done to inflate the stock price or hide financial difficulties. Number two is off balance sheet financing. Companies might structure some borrowings as lease or other off balance sheet arrangements to keep them hidden from the balance sheets, reducing their reported debt levels. Number three is bonds, debentures to related parties issuing at inflated prices to create a false impression of strong demand and artificially boost the company's reported borrowings capacity. Fourth is improper use of proceeds, such as using the money for personal gains or management and creating financial difficulties for the company. Fifth is lack of transparency, withholding or obscuring relevant information about the debt through overly complex disclosures or unclear footnotes. And sixth one, not compliant to the requirement of mention in the para 8.3.1 in the guidance note. Type 2, long-term borrowings related, for example, secured term loans. Important aspects for the F&A are: number 1, principal amount, interest rate, repayment schedules, maturity dates, security details, covenants, disclosing any financial or non-financial covenants attached to the loan agreement, and statutory requirements in the guidance note in the revised schedule 6 to the Companies Act. Now, if any inaccuracies are there in these can lead to incorrect financial reporting. Let's go to the unsecured term loans. The first one was secured term loans, second one is the unsecured term loans. Again, similar aspects like principal amount, interest rates, repayment schedule, maturity date, guarantees if any third party guarantees are provided for the loan, and number 6 is subordination if any, that is indicates if the loan is subordinated to another debt obligations. This means that the creditors would be paid first in case of a company liquidation. Now, inaccuracy related causes for the long term borrowings: incorrect principal amount, recording incorrect principal amount, improper interest accruals, omission of fees and repayments, not reporting loan origination fees, repayment penalties or other associated cost can understate the total cost of the loan, incomplete disclosure of the terms, omitting some details, and classification errors like classifying a short term loan as a long term and vice versa, and manipulating the financial ratios. Ethics related causes: intentional misrepresentation of the, for example, deliberately manipulating the reported amount, interest rate or other terms of the loan, hidden side agreements like the company might have undisclosed agreements with the lender which could create a different picture for the loan risk, fake collaterals, using inflated collateral valuations or pledging non-existent assets as security, improper use of loan proceeds, lack of transparency, withholding or obscuring relevant information about the loan details through the overly complex use of the company's liabilities, non-compliance to the guidance note 8.3.1.8 terms and loans from banks and other parties. Type 3, secured loans and advances taken from the related parties. This is the third type of the non-current liabilities. Here the aspects are principal amount, interest rates, repayment schedule, security details, nature of the relationship, which is identify the related parties who provided the loan advance, for example, director or subsidiary, etc., and subsequent changes, disclose any subsequent changes to the loan terms, for example, interest rate changes or extension of the maturity period, etc. Now, unsecured loans and advances taken from the related parties. These are like similar thing: principal amount, interest rate, repayment schedule, nature of relationship, settlement terms, specifying the repayment terms such as demand clauses or offsetting the against receivables from the related parties, purpose of the advance, and statutory requirements as specified in guidance note number 8.3.1.20 and relevant accounting standards. Now, inaccuracy-related causes that can cause adverse reporting of this non-current liability in the balance sheet. Number one, incorrect principal amount, intentional or unintentional errors in data entry or calculations, non-arm's length interest rates on related party loans that are non-comparable to the market rates, omission of disclosures, classification errors, and hidden agreements like not disclosing side agreements with the related parties that after the repayment terms or collateral requirements. Ethics related aspects causes are related to the secured loan advances are, and number one, intentional misrepresentation. Management may deliberately manipulate the reported amount, interest rate, or other terms of the loan. Fake related party transactions. These deceptive practices involve creating fictitious loans or advances from related parties to inflate the company's cash position or hide the true source of funds. Number three is restructuring the loans, continuously rolling over or restructuring the related party loans to avoid default, creating a situation where the company is essentially insolvent. Undisclosed personal guarantees. Management might obtain related party loans with undisclosed personal guarantees, potentially putting the companies at risk if the guarantor defaults. Lack of independent oversight. The absence of independent review process for related party transactions can increase the risk of manipulation and unethical practice. And here the non-conformists are General Guidance Note number 8.3.1.20 and Accounting Standard 18.21, A 18.23 and Accounting Standard 18.24 and 18.26. Type 4. Long-term maturities of leased obligation. Important aspects for the F&A team are lease classification, that lease is classified as finance lease or operating lease based on the criteria outlined in the accounting standard. Present value of the lease payment, finance lease only, relevant for finance lease only. A key aspect to consider, this value is calculated for the remaining lease period, providing a clear picture of the future lease obligations. Lease term and maturity, specifying the total lease term and the long-term breakdown to understand the future cash outflows related to the lease. Fourth is lease rentals, optional, which is optional for disclosing, though not mandatory, disclosing the minimum lease rental payable over the lease term. Contingental rentals, if applicable, if the lease agreement includes variable lease payments based on the future performance or usage, disclose the estimated amount of these contingent rentals and the basis of estimation. And sixth is subsequent measurement. For finance leases where lease payments change due to revised estimates or lease modifications, disclose the impact of such changes of the lease obligation. And number 7 is accounting standard requirements. Inaccuracies related causes. 5 causes are incorrect lease classifications, misclassification of the operating lease as a finance lease can lead to a significant overstatement of the liabilities on the balance sheet. Inaccurate present value calculations, understating or overstating the lease obligation affects the company's reported debt and profitability. Omission of lease disclosures, inadequacy in transparency to disclose the lease terms, minimum lease payments, or contingental rentals can make it difficult for the investor to assess the company's future cash outflows and lease related risks. Number 4 is improper treatment of lease modification. Changes to the lease agreements such as rent extensions or buyouts might need to be reflected correctly in the reported lease obligations, leading to outdated financial information. And 5 is intentional manipulations, deliberately understating the lease obligations to improve the financial ratios of the company's debt burden. Ethics related aspects for long-term maturities of lease obligations. Off-balance sheet structuring, deliberately structuring lease as an operating lease even if they meet the criteria for the finance lease, thus keeping the lease obligation of the balance sheet to improve the financial metrics. Hidden lease agreements, failing to disclose all lease agreements, particularly with those related to those related parties. Undisclosed lease or termination penalties, not revealing potential penalties for early lease termination can underestimate the true cost of the lease obligation. Partial disclosing lease terms Lack of internal controls like intentional manipulation or weak internal control over the lease accounting can increase the risk of errors related to the lease obligation, and non-conformance related is not following the accounting standard 19 related to this. Type 5, long-term deposits taken. Important aspects. Usually, deposits with a maturity of less than 1 year are classified as current liabilities. However, there could be some exceptions or specific situations where long-term deposits might be considered as a non-current. Now, number one important aspect is special deposit with extended maturity beyond 1 year. The disclosure would likely include the total outstanding amount and the maturity dates of those long-term deposits. Number two is lease security deposits, if significant. Security deposits received from the lessee for long-term leases, usually exceeding 1 year, might be classified as non-current liabilities if the amount is significant. Advance payments from the customers, if treated as liability. In rare cases, companies might treat advances payment received from the customer for official service or deliveries with a fulfillment period exceeding 1 year as liabilities. However, the more common accounting treatment would be to classify them as advance payment from customers rather than putting them under current liabilities or non-current liabilities. Statutory reforms conformance related. Inaccuracy related causes with respect to the long-term deposits checker. Misclassification of the deposits, like short-term deposits might be mistakenly classified as long-term, in inflating the non-current and understating the current liabilities. Inaccurate maturity dates. Incorrectly reporting the maturity dates of long-term deposits can lead to misleading information about the future cash outflows and repayment obligation. Omission of significant security deposits. The failure to disclose significant leased security deposits held as non-current liability can grossly understate the company's total liabilities. Number 4 is improper treatment of advance payments. If the advance payments from the customers are incorrectly classified as non-current liabilities instead of current liabilities, it can create an inaccurate picture of the company's short-term debt obligations. Number 5 is errors in calculating the deposit amounts. Arithmetic errors or mistakes in data entry can lead to inaccurate reporting of the total amount of the long-term deposits taken. Ethics-related causes. Long-term deposits taken. Intentional misclassification, deliberately classifying short-term deposits as long-term to manipulate the financial ratios. Hidden deposits. Incomplete disclosure of the certain types of long-term deposits, particularly those related from those from the related parties, can conceal the true extent of the company's liabilities. Inflating security deposits. Overstating the amount of the lease security deposits held as non-current liabilities could be used to create a false impression of the strong financial position. Fourth, delaying recognition of the advance payments as revenue. Companies might hold on to advance payments as non-current liabilities instead of recognizing them as revenue when received, manipulating their reported earnings. Lack of transparency, omitting clear disclosures about the nature and terms of the long-term deposits or security deposits can make it difficult for the investor to assess the true risk associated with these liabilities. And non-statutory conforming are General Guidance Note number 8.3.1.19. Deferred tax liabilities. This is type 6 non-current liabilities. Important aspects are total amount to be disclosed, nature of timing difference, describing the difference in the recognition of the income or expense for tax and accounting purposes, that is depreciation methods, etc. Tax rates used, current and future enacted tax rates depending on the nature of the timing difference. Maturity analysis, which is optional to be reported. Sharing the portion of the deferred tax liability expected to be reversed in each of the following years. Measurement and uncertainty. This is if it applicable, disclosing the nature and extent of the uncertainty and changes in the deferred tax liabilities, if any significant changes in the deferred tax liabilities compared to the previous period and reason thereof, if there are major changes, and statutory requirements. Inaccuracy related causes related to the deferred tax liabilities. Errors in identifying the timing differences, understatement or overstatement of the deferred tax liabilities, incorrect tax rate applications, using inappropriate tax rates, miscalculations, mathematical errors, inconsistent accounting policies, changing in the accounting policies without proper adjustment to the deferred tax liabilities, and omission of disclosures, not providing the adequate disclosure about the nature of the timing differences, tax rates, uses, or measurement uncertainties. Ethics-related causes related to the deferred tax liabilities. Aggressive accounting policies pursuing companies might adopt very aggressive accounting policies that create large timing difference and a lower deferred tax liabilities. Manipulation of the tax rates. Third is under provisioning of deferred tax liabilities. Companies might intentionally underprovide the deferred tax liabilities, creating reserve that can be used to manage earnings in future. Lack of transparencies, management override of internal controls. For example, intentional manipulation or weak internal controls over tax accounting can increase the risk of errors in the deferred tax liability reporting. And lastly, non-conformance related to the statutory requirements, General Guidance Note number 8.3.1.9 and Accounting Standard 22. Future references. Building on Profitability and Ethics, which was my second book released in November 23. This blog focuses primarily on the non-current liabilities related aspects. Please stay tuned for the insight. My forthcoming book, third book, will be diving deeper into the smart balance sheet strategies and ethical practices that can unlock the profitability. You can please refer to some of the articles of interest on the following, which is my website address given here, www.ethicalprocess.com, facebook.com, and linkedin.in. Thank you very much.